first, we begin with the markets, as we always do here on NYSE Live. Joining me now is Ted Thatcher. He is the founder and president at Bright Lake Wealth Management. Ted, welcome to the New York Stock Exchange.
It's great to be with you as always.
A little bit of a change of a pace. We're usually in the studio, down on the floor.
Perfect.
So we're about 30 minutes away from today's session. What are you expecting?
You know, obviously earnings is in full swing here. I have my eye really on what happens with big tech. Google releases on Wednesday. I think so much of the AI trade, so much of the compute demand discussion, and really the broader discussion about whether or not we're going to see ROI fast enough on all this AI CapEx spend is sort of being put on Google's shoulders right now. Are they going to hit that 60% year over year trend continuing on the expansion of their AI and cloud business? $22 billion in revenue in that segment is what we expect there. If they can push higher than that, I think that that's a really good thing. Fundamentally, these mega cap companies have to battle this narrative that overspend is not overspend, that they are seeing the revenue out of that, and that's going to be what I have my eye keyed in on today.
You say there's a difference between AI suppliers and spenders. What do you mean by that?
Yeah, so much of the trend from the beginning of 2026 to today, the market growth hasn't been driven by the Mag 7 names. That's completely out of the ordinary for the last several years. Since 2022, of course, the markets have been led by those mega caps. This year, it's been the memory names, the chip names, the semiconductors, and of course, the broad earnings in the market. The S&P 493 is up about 10% compared to what I think you could call the Lag 7 even. And so, in order for the baton to sort of get picked back up by those traditional, if you will, Mag 7 companies, we do need to see them battle that narrative the right way. I think what would be a weak sign is if we see some of these big mega caps just point to balance sheet growth. You know, Google, for example, has a stake in SpaceX. Huge growth on that. Other names, of course, have stakes in OpenAI or Anthropic. That's not going to be enough for the markets. It wants to see real ROI on that spend.
Do you think we're going to see large amounts of CapEx spending on AI as we did last earnings season?
I hope that they learned the hard way last earnings season, and we don't see that. I think the market actually wants to see discipline first, operational efficiency, growth again in all that RPO, that pent-up demand that they have written in contracts needs to convert to actual revenue. I think, though, the compute demand persists, and that to me actually says there is a real opportunity for the baton to get picked back up the second half of 2026 by those Mag 7 names, and one of the reasons I'm constructive about the rest of 2026.
Aside from big tech, what is your pulse on the rest of the earnings that are coming out?
You know, so far we've seen a real positive quarter. You know, 80-ish% of companies across the S&P so far are beating earnings, still above average, not quite as good as it was in Q1 of 2026. But I do believe that the broad market is also driving earnings. And what I like about, you know, how I see the second half of the year beyond what we've already talked about is there's multiple ways for the market to win. It could be continued broad earnings growth. It could be the Mag 7 companies taking that baton back. And so certainly it could even be more compute demand underlined this last week by that Kimi K3 model release, driving costs down so substantially for tokens that, again, just underlines how in demand and how compute constraint the demand in the AI world is.
Speaking of a winning market, I understand that you see the S&P 500 hitting 8,000 by the end of 2026. What is the path there?
Yeah, so like I said, I believe the market can win in different ways, but I want to be clear. I do not believe we are just on a green upshot from here. I think that the market it has to be, I actually think it's consolidating in the right way, a healthy way with all these chip and memory names this morning looking strong actually, but I do think that we could see a world where we see kind of a further constraint and constriction in the markets because there is all these headwinds. The market's still digesting a new Fed chair in Kevin Warsh. The AI economy sort of cooling a little bit. Some of the secondary and tertiary effects of this elongated war in Iran. But I do believe we can get to 8,000, and I'll tell you why. Beyond what we've already discussed, the market is cheaper today than it was at the beginning of 2026. Coming into 26, if you look at the S&P 500, it was priced at about 19.4 times forward earnings. Because of the incredible earnings growth that we've gotten, that number has actually come down to about 18.4 times forward earnings. And so from a fundamental standpoint, that's why one of the reasons I would say I'm constructive about the second half of 26 as well.
You just said we might see some constraint. Do you think it's healthy for a market to have some pullback?
Yeah, it's so funny when we see a big run up and a big rally, everyone starts to get nervous. And it's, of course, always scary to try to call the top, but markets are cyclical. And if you just look at the run up in semiconductors and, that whole chip memory layer, if you look before ChatGPT launched, it was about 4% of the S&P 500. Today, it's 20% of the S&P 500. So a little bit of a pullback, I think is normal and I think is healthy. I think stocks is maybe down, maybe about 18% or so off of its highs.
All right, and tech obviously dominating the headlines, especially with those big tech earnings coming out on Wednesday. Are there any other parts of the market that you're looking at right now?
We didn't talk about Tesla, but Tesla that comes out, I think that the market's going to be looking at that. I do want them to see, of course, earnings beats, but, it's not just about deliveries with Tesla. They have a good year-over-year number, about 480,000 vehicle deliveries, but that's not what holds up Tesla's valuation. It's going to come down to certainly robotics, any further announcements they have with Optimus. But what I want to see about Tesla specifically is how FSD is doing. Are they getting more and more revenue there? And of course, the robotaxi business.
All right, Ted Thatcher, founder and president at Bright Lake Wealth Management. Thanks for joining us on the floor of the New York Stock Exchange.
Always
So
a
good
pleasure.
to see you.
Yeah.